Hello everyone, I've been asked to answer 3 questions to help investors before they decide to invest into bonds. So the first question is, what advice would you give to an investor in his 60s who is looking to invest in a diversified bond portfolio to supplement his CPF life payments? I think it's a very good question because sometimes CPF life payments may not be sufficient. So, well, an investor needs to first understand the risks of investing in bonds. And some of the more common risks would be interest rate risk and credit risk. Now, what is interest rate risk? Now, interest rate risk is the risk that interest rate might rise or fall, making the value of your bond either lower or more. And to mitigate this, the investor should buy a bond with a maturity that matches his investment horizon to reduce the uncertainty of the income stream. And as long as he does not sell before maturity, the market price of the bond is only just paper value. It doesn't matter that it moves up and down due to the interest rate fluctuations, because as long as you hold to maturity, you are going to get your principal back. Investor is going to get his principal back. But that is only if the bond does not default, which brings me to the next risk, which is credit risk. So credit risk is really the risk that the bond might just go bust, or the company might just go bust and they can't pay you anymore and the bond goes into a default. For taking that risk, well, you get the return above the risk-free rate of an issue of similar maturity. Now, to mitigate credit risk, an investor can buy sovereign bonds or government bonds issued in the currency that he requires income in. And in the case for a Singapore investor, well, it should be the Singapore Government Securities or SGS. But, well, because you are investing into a government bonds or a sovereign bond, you have to expect a low yield. So the current yield for the SGS 1 year is 0.23%, 5 years is about 0.48%, and for 10 years, 0.91%. You can imagine it's so low, right? And because Singapore does not set its own interest rate, we are affected by the interest rates of the countries that our currency is weighted against, usually our trading partners. And given that these partners, such as the US, the EU, Japan, and UK, are all very low interest rate, or some at zero interest rates, well, our rates are very low too. So the advice is this: I think we need to be, if you're going to invest in bonds, right, I think we need to be very realistic about the yield. If you are looking for high yield, and today by that I mean 3.5 to 5.5 or 3.5 to 5% can be considered high already, then do note that you are taking some risk. In fact, quite a bit of risk. But, well, there are other ways that you can get income at a higher yield to supplement your CPF life payments without investing into bonds. So what we usually do for retirees is that we spread the client's money into various buckets, and buckets that you need immediate drawdown, say over the next 5 years. Well, you don't invest it, you put it in cash, right? So that, well, if the market fluctuates, whether it be the bond or the equities market, it doesn't matter because you are in cash. But monies that you don't need immediately, you need 5 years later, 10 years later, 15, 20, 25 years later, you can now put them into portfolios made up of equities and bonds. The monies that you need sooner, like in 5 years' time, has more allocation in bonds, whereas monies that perhaps you need 25 years later, you can have more in equities. And in this way, by spreading your retirement money into different buckets of different portfolios, different asset allocation, you get a better income than just buying sovereign bonds, and yet you can lower your short-term risk. Now, I've got a second question, which is, what advice would you give to an investor in his 20s or 30s who is looking to start an investment portfolio? So, a few things. Firstly, before you even invest, make sure your financial foundation is strong. And by that, I mean you must first have an emergency fund, and then make sure your debt level is not too high. You are adequately covered by insurance. Once you've done that, you are ready to invest. And since you are just in your 20s or 30s, you do have a very long time horizon. So I would suggest that you put more of your money into stocks, or otherwise also known as equities. Why? Because stocks and equities, they have the highest expected returns. And given the long-term horizon of this investor who is only in 20s or 30s, there is time for the investor to ride out the ups and downs. Now, particularly now, I would say value stocks are at its widest spread versus growth, as it has underperformed tremendously in the last 10 years. And given that, well, value has done better than growth most of the time from past 100 years of data, it might make sense that when you buy stocks, you tilt more towards value. Also, seek out a diversified global portfolio, as we do not know where the best returns will come from. So diversification will help us hold the best performing stocks in any period. Now you might ask, why stocks? For a simple reason that the equity premium, okay, sounds like a big word, but well, the equity premium means the excess return of stocks over risk-free bonds is right now the strongest. And well, stock being risky should also give you a higher expected return, right? And since you are young, you want to compound your savings at a higher rate for you to reach your goals. But I understand, well, yes, with the returns, it comes that volatility. And if you don't like it, you cannot take the volatility. And if that causes you to jump out and jump in of the stock market at the wrong time, then well, put some bonds into your portfolio to cushion that volatility to help you stay invested for the long term. So I hope that helps. Now the final question. So what questions should investors ask before investing in a bond? And how do they ensure that they only invest in the right ones, in the quality ones? This is a really loaded question. Well, I'll say first, ask yourself whether you intend to hold till maturity. Now, as mentioned, there is interest rate risk. And when you invest in bonds, and if the investors, they don't hold till maturity, the interest rate movements will cause the investors to lose money when you sell off the bonds at the wrong time. And that's the first thing. And the second question you might want to ask yourself is whether you can accept the currency risk. Why? Because even if you make money buying the bonds, you can still lose money due to the foreign exchange. So ask yourself, when you buy that bond, the currency, can you take that currency risk? And after you have decided, just before you go out there and buy the bonds, you need to assess an issuer credit worthiness. And well, this requires a lot of fundamental analysis of the issuing company. What do I mean? Well, I did say this is a loaded question. First, the investor should seek to understand the business dynamics and the macro environment of the issuer, the company that you are buying the bond from. What business are they in? And does the macro trend generally support their business, and as such, they will do well enough to pay you back when the bond matures? Next, well, investors should analyze the financial statements of the issuer to have an understanding of the debt maturity profile. And by that, I mean, are there a lot of debts that are maturing at a certain time? And they should also know the existing cash levels and the ability of the company, the issuer, to generate free cash flow from operations to repay the debt. I mean, you need the company to be making money so that they can pay you the bond that you buy, right? Because essentially when you buy bonds, you are lending money to these companies. So you want to make sure that the companies are generating free cash flows. Then they should read the term sheet of that bond, the issue that is being offered, to understand any covenants that are specific to the issue that they are considering now. Big word again, covenants are basically agreements in the bond contracts that restrict or prohibits the issuer from certain activities. They should then analyze the ability of the company to pay down its debt based on the assessment of the ability of the company to generate cash. Now, this should give them a sense of the ability of the company to pay its interest, the coupons, and its debt. And if the company is able to service the issue that they are considering to invest in. So quite a bit of things, well, to fully evaluate if this particular bond, well, meet your required rate of return, meet the investor's required rate of return. Well, perhaps you should also run a similar analysis of companies, of similar issuers that have existing comparable bonds to assess if there is an option that is suitable to the one that's being offered now. And on an ongoing basis, it's not the end after you buy, right? And on an ongoing basis, when the company reports its result, well, either quarterly or semi-annually, the investor should now take into consideration this new information, the business outlooks, the financial to assess this bond, whether it's worth your while holding on to it. Lots of work to do before you invest in a bond, and if you find this to be too cumbersome, too technical, too difficult, well, you can always pay like 0.2% just to invest in a very low cost, diversified global bond portfolio with the help of your wealth advisor. So you may want to speak to your wealth advisor about it instead of doing all this due diligence, which I understand can take a lot of time. So once again, I hope, well, these answers, they are of some help to you before you make your investments into the bond market. Thank you.